One, and we are live. What's going on, everybody? Welcome to Wolf. Happy Monday. It's good to see everyone out there. I feel like a lot of stuff has happened. We've been going super hard here at Wolf. Sam's just jumped up in here as well. Literally 2 seconds after we started. So great timing there, Sam. But yeah, whole lot of commotion going on in crypto land. So I know a lot of stuff is going on in the stock world because the worlds are starting to connect here. And so I'm really excited to be joined here with John Tinsman from AOT. And talking about growth investments, different opportunities in the markets. They've got some really, really cool things that they're offering. And actually, John was literally just in New York. And I want to let him kind of talk about his experience the last few days. You've been out on the New York Stock Exchange a little bit, shaking hands, rubbing shoulders. So I do want to hear a little bit about this experience and maybe a bit of background on you and the company a little bit as well before we jump into the conversation.
Yeah, so I'm John Tinsman. I'm the CEO. I started AOT Invest. I'm the fund manager to the AOTG and SOFL ETF. SOFL just launched. It's a 2x daily software platform ETF. So I was out in the New York Stock Exchange with some of my partners and my family, ringing the New York Stock Exchange bell. So that was pretty fun. Kate, I don't know if you saw it, but I brought my little kids there. So
I did. I didn't know if that was your kids.
But they're like, yeah, this is for C-suite executives. Well, when you've got your own company, you can afford to get creative with titles. So, so that was a good time. And then like I have AOTG that's on the NASDAQ. So, you go over to the NASDAQ, you do shows over there. I did trade talks. I did FinTech TV. I did the Nicey Live TV.
Wow.
So it's just like a lot of shows. And these anchors are like so professional. You're like, man, you have no idea how much like goes into live television until you're actually there and you see like the sets with like the robotics, like cameras. And you're like, oh my gosh, this must cost a fortune. And like to schedule like a different appearance for every 20 minutes or something. I'm like, I can't even imagine. Like, no wonder they have commercial breaks. They need it. Like they would be able to breathe. So the markets like hit record highs last week. My funds were, SOFL launched or hit a record high. It was up like 6% from the launch and it just launched and AOTG hit a record high. So that was, that one started trading in the 24s 3 years ago and it hit like 53. So it was like doing very, very well. There's just been a lot of interest in these funds and in general, I think like technology and software and, the AI story is just a really compelling one today in the moment. And so at the same time, we saw all the earnings releases the last 2 weeks. And that was really fun. Like the worst one was Amazon, right? And like Amazon only grew their earnings per share at 33%. Kate, how would you feel if you got a 33% raise every year? You'd be like, this is great. Like, I'll take 33%. That's the worst one out of the whole batch. Like, can you imagine that? Like Google's at 50%, Microsoft's growing their earnings at 50%. Palantir just came out, 100% earnings growth, very strong revenue growth acceleration.
Yeah, I saw Sam tweet about that as well, Palantir. I think you're muted, by the way. If you're gonna hop in there about Palantir.
Apologies. Yeah, no. But go ahead and finish with the with ring the bell. That seems like a really cool. I was actually gonna ask you. I've always wondered because I've seen like so many of the bells being rung, and even as a kid, like I'm really happy for your kids. It's an amazing opportunity. Like I've always dreamt about doing that myself. Got the opportunity with Title Financial Group, which you know as well. The other month to ring the bell at the NASDAQ, hopefully New York Stock Exchange soon. We'll see. But I've always wondered, how do they get up there? Because there's no back door or anything. Did they bring a crane in there? What did they do? Oh, you're on mute.
It's a sliding door and that's a screen. So they shut it and the screen turns on and it says like your logo, like AOT Invest or whatever. So like crazy. It was, awesome. It was, let's see, is this my share screen?
Yes.
And so it was pretty cool. Let's see. So yeah, I mean, you can see the little kids up there, right? And it was a good time. So that's like a screen in the background. It's not like a banner. And yeah, like I had done the NASDAQ 3 years ago when I launched AOTG and like, look, the NASDAQ's really cool. And actually when I was back there, like Mr. Beast was at the NASDAQ, like ringing the bell with the charity. And I like, so you're all hanging out in the same lobby. I'm like, it's like crazy. And you've got like all the CNBC anchors and stuff. So it really does. Like I'm from Iowa. It's like you get onto Wall Street, you've read about this like your whole life. Like, and then like you're there, like it's Wall Street, the New York Stock Exchange, like Times Square is where NASDAQ is. You're meeting all these people, and everybody's so smart and talented at these companies, and like the anchors, you're just blown away because these are like not like the everyday people you interact with. And even the ones that aren't stars are stars. Like that's like the best way I can put it. And yeah, I mean, like the NASDAQ is at the center of like the world, or not the New York Stock Exchange. Like it's where they ratified the Constitution. It's where they penned like the Federalist Papers. It's where they made the Federal Reserve. Like that building right there. And like they had us in like this beautiful banquet hall. Like everything's marble and gold. It looks like you're at Mar-a-Lago, and I've been there too. And that's a really beautiful ballroom. Like the ballroom is like $70 million of 24 karat gold on the wall. And you're like, who would put this in one room? And all the rooms at Mar-a-Lago look like that. But like the NASDAQ rivaled, or the New York Stock Exchange rivaled that. And then you get on the trading floor and everybody's clapping and it's like so much energy. And I don't know, it was really exciting time, and the market was dropping that morning, and there's TV cameras everywhere for all the news shows. And it's just really exciting is the best way. So you got to do the New York Stock Exchange. The NASDAQ one's so fun too. But yeah, I mean, it was great. 10 out of 10. The kids had a great time too, the whole family. So yeah, it was fun.
That's amazing. I mean, seriously, like I'm always very thankful to be blessed in these scenarios. I mean, you said you're from Idaho, so I could imagine like the usual kid around that grows up in Iowa. They're probably, not like, oh, I'm going to go back to New York City. I want to ring the bell. Maybe they do, but just given the opportunity to do it. And I wouldn't really section yourself out in that. I mean, you're a really smart guy too. You run funds as well. And you're really young too. Like you're very early in the game. Not trying to knock it or anything, Kate. I know you're young too as well, but I mean, to be able to get into the game and be able to own your own fund, own your own company, and then be on the forefront of ring the bell in Wall Street, you've done a lot, and that's very admirable to actually get there. Especially the fact that you rang the bell in the NASDAQ 3 years ago, like right on the bottom of the 2022 bear market at the beginning of the explosive AI trend.
Yeah,
that is a great way to kick off an entire decade or multi-decades of just the AI wave that's just going to revamp and disrupt everything in the entire world. So jumping from that one, I noticed one of your top holdings is Toast, and that's actually very interesting because I have a lot of investments in the retail space, in the fintech space as well. I don't own Toast. I wish I had done the research on them more ahead of time in order to buy in on them pretty early, probably like around the mid 30s. But now the trading, I don't think it's the all-time highs. I think their all-time highs was back in 2021. But I see Toast everywhere. I see all those little terminals every single place I go to, especially when it comes to restaurants. They're the leading forefront of that. I was on the spaces this morning with you. Really awesome how you guys went through that. How you not only have a software company, because I do believe that a lot of the companies that we see today are more software companies and data companies than anything, but then they also rent you the hardware as well to basically lock you into the ecosystem. I mean, if you're using the Toast operating system for your POS systems, you're going to need their hardware. And once you train all of your employees to use the hardware and so on, it's very hard and a very sticky business to actually get out of. So can you like go through like what gave your eyes on Toast as far as a company goes, and why you chose Toast over, let's say, Square or Block XYZ or one of the other POS systems as well? And also, I think it's in the private markets as well. Aloha, I think it is a very big one in the private markets. I'm not sure if they trade publicly or anything, but yeah, like why did you pick Toast out of all of those?
Yeah, so first, like I want to go back to, you said launching at 2022. There were people in Bloomberg that wrote an article that were like, how dumb is this to launch when like the stocks are down? Like these people are so dumb. Like they did not realize that the best time to launch is when stuff is down. It's like launching Bitcoin after a 50% pullback. Like it's like a Bitcoin fund. It's like, that's the best possible time to do it. I don't know. Anyway, so they don't slam me in the press anymore, but, I mean, so Toast, I mean, so think about this, right? Like I like companies that the cost of an additional sale is next to nothing, right? So like, what does it cost Toast every time you swipe your credit card? Like they're processing the payments, nothing. Like they could just take it like a 2% fee, right? So like their cost of additional sales comes at 100% profit margins. They also have a software business. Like when you go online, you might order food, make a reservation. That's Toast. You get a text message. Your reservation's coming up. That's Toast. The people staffed at the restaurant get a restaurant notification. hey, you've been scheduled to work on these 5 days at these hours. That's Toast. They do everything. They do like the employee management, they do the payroll, they do the accounting, they do they can make websites for you, they can do the online ordering, they process every payment, they have all the hardware, and it's a comprehensive restaurant solution software and payment processing. Now, these things, now you see Toast everywhere you go. I don't know if you're in a big city, but like they're everywhere. Like you can't go anywhere in New York City or whatever, Chicago, without seeing Toast. You don't see it everywhere like in Iowa. You see it most places, but there's parts of the country that are slower to adopt. And those people are adopting it very quickly right now. And the other thing about Toast is you start using them for one thing, and you're right. They say, hey, this is, look, you were talking about the stickiness of it. The stickiness is like, I don't think relevant. They save the people so much money. Like if they didn't go through Toast and they had an accountant, they had a different payroll, and they had a different like staffing, and they had a different payment processing, and they had to go to Visa and buy their own terminal and pay 4% plus a couple $1,000 a year, they'd be making way less money, right? So Toast not only helps them like manage their restaurant with a lot less man hours, it also helps them pay less in credit card fees, so they make way more, and it also helps them with everything, every other aspect of the business. And that's like, it saves them so much, and it's so valuable to them that everybody that uses it says, I would never go with anybody but Toast. Like this is the best. Oh. Right now, the only place you don't see it, Sam, and I can see why they call you Sam Solid, because you're pretty solid, but the only place you don't see it is the rest of the world, right? So like you go to London, you don't see it anymore. You go to like whatever, France, it's not there. Like you go down to Argentina, Buenos Aires, it's not there. And if we know anything about American software, it doesn't matter whether you're talking about Facebook or Google or Microsoft, it's they make it and they build it in the US, and then they sell it at 100% profit margins across the rest of the world and become 100 times more profitable than anybody could ever have imagined. Okay. So look, Toast is up 100%. You're like, who's been writing that one? Me. I've been writing that. You know, the fund's making millions of dollars off of Toast. But like, AOTG like has been around longer than Soffle has been. So that's the fund I'm talking about, making millions in Toast. And like, it's up 100%, right? But the earnings are up 167%. So it's actually, the stock's going up less than the cold hard cash they're bringing in, right? So like it's actually getting cheaper when you look at it, because like they're just making so much money and so much more than they made the last year. And like, what's the future of that? The future is the international expansion, the continued vertical integration and expansion across the rural areas of the US. And like, there's absolutely no reason to be bearish on Toast. But like, I think the other thing, Sam, is like when you think about Amazon, right? So like Amazon was just a books e-commerce seller. And then they're like, well, we already do books. Why don't we just do everything else, right? Like no brainer. Yeah. And then they're like, well, now we've already got data centers for our e-commerce. Why don't we just help other people with their web stuff also? Then they've got Amazon Web Services. So like, what does Toast have? They have payment processing, so they can go head to head with Adyen, Shopify. They can make websites for people, you know, right, like that. They can do payment terminals at any place, so they can go head to head with Square, like in Visa. When you think about like what Toast could actually do, Toast is poised to not just be restaurants. They have built all the hardware. They've built all the software. And there's absolutely no reason they couldn't do a department store, right? And do all the staffing and do all the whatever. There's absolutely no reason why they couldn't do any store to store, even like a Shopify store for like a little shop. Like Toast can do it all. What is the future of Toast? The future of Toast, I think, is enormously big. And so I've got it like at a 7% weight, which is way overweight when you think about like it's only like a $25 billion market cap. Well, I haven't looked at it a week. It's probably like 30 now, but I mean, it's pretty good. And like, you want to own companies that create a lot of value for people, that are always growing the value they create. So they're innovating like Toast is. And then also that like they just actually make money, right? Like you don't want to own the unprofitable ones, because something's wrong with that. Like if their products aren't valuable enough that they can't make money, like it's not like a good sign. So anyways, you heard it all about Toast now, Sam.
Yeah, no, that's really cool. I mean, a lot of what I invest in is really centralized around a sticky product or the moat. One of my biggest investments that I have is Mercado Libre. They just reported earnings today. It's down. I don't know. I don't like, so usually with like the short-term moves with long-term investments, I don't necessarily care about any of the short-term fluctuations. And you do have a lot of the companies that are reporting in the fintech sector as well. And one thing that I've seen was a lot of turnover in terms of specifically in the POS systems that a lot of restaurants do have. And then I live in LA, so I see, I'm seeing Toast everywhere regardless over here. But then I also see other places where they have, like those older POS systems, or like they don't have a system where you can even use Apple Pay or anything, which is kind of odd to see nowadays, because in Europe, they literally have Apple Pay everywhere. Like there's not a single place that does not have Apple Pay in Europe. Maybe that's because of the take rates and so on. I don't know. But as far as I can see it, places still do charge that dollar fee if you want to use a credit card and so on. So they kind of push you into using a debit card with the legacy transaction systems. And then places that actually do meet the managers of restaurants. And I'm just like, have you guys ever looked into, I'm not a salesman for Toast or anything, but like I always like suggest it to them, and their answer is always like, oh, they take a lot of fees and stuff, but what a lot of companies don't necessarily do nowadays, and this isn't just with restaurant companies, but they don't consider the forecast of their future revenues that they could be bringing in that would make their business actually much more profitable, even if they were to take that short-term margin hit. I think a lot of companies are actually afraid to make that investment, especially when you come to the mom and pop shops. But then you have larger companies out there and enterprises, even smaller companies that have become larger enterprises that have done that. Let me invest now and hit my margins now for the return later. And a lot of your holdings have that in your portfolio. Like Amazon, for example, we just talked about Amazon a lot, which is my largest holding. Actually, I've been invested in Amazon for almost a decade now. But when I think about Amazon and seeing all the CapEx that's happening, especially the massive CapEx upheaval that they had back in 2020 when COVID happened, and they were building out a behemoth of a logistics system, which everyone thought Amazon was not going to go out of business, but they thought the company was going to get hit pretty hard, which it did. It was down like 100% during 2022. But then you turn around, you look at where that's today, it's like, well, that was all worth it. And on top of that, they had their huge CapEx that they're doing into AWS right now. And I think one of the reasons why the stock actually dropped after earnings was not necessarily because of the fact that, Amazon's going to zero or anything, but because of the fact that the market is really pricing it up, mostly because it's the largest hyperscaler in the world. They do forecast the company to continue being the largest hyperscaler in the world. And then they see them only grow 17% year over year in terms of their AWS growth. And then Microsoft goes a phenomenal 39% year over year, which I'm still like blown away by that. Google's like around 33, 35%. And then Amazon's here at 17%. But what people don't remember is like, okay, but this is a $123 billion run rate business with very high margins. So it's okay if they're kind of losing in terms of the growth at this size. But I think that at some point, Microsoft could be head to head in terms of growth. But I think whenever you think of this entire CapEx cycle, it's going to benefit all the players.
Microsoft's going to be quite a bit ahead. I mean, I think Microsoft's going to be the best one of them.
Well, they do include,
of like the Mag 7, like, I mean, there's NVIDIA obviously, but like, I mean, the thing with Microsoft, Sam, is that like they have Copilot, which is like the AI for business, so they can do. Look, at the end of the day, businesses are going to pay the most for AI. Okay. And the most helpful things that businesses do is they make Excel, they make Word documents, they make like PowerPoints. So like if you can automate a lot of those tasks, that's what businesses are going to pay the most for. Like Microsoft, obviously it's their programs. So like they've got a big leg up. They just said that they did hit 100 million, like 100 million Copilot subscribers, right? And like, like these additional sales are going to come at 100% profit margins. Do you know Copilot's like 5 times the cost of Microsoft Office? So they've come out with a product that's going to bring in 5x more revenue than their biggest product. And its growth rates are like in the hundreds of percentage points, right? So you're going to see, as this trends towards 1 billion or 2 billion users, you're going to see a very sharp revenue acceleration. And you're going to see a very sharp rise in profit margin. I mean, that's my opinion of it. They're going to do this very profitably. So, I mean, I think nobody has a bigger leg up in businesses who actually pay the most for AI than probably Microsoft, just because they've already got their foot all the way in the door. Every business buys Microsoft.
Yeah, no, for sure. I think there was something like 90% of the computers are Windows in all of the enterprises, probably a bit more than that nowadays. And they all have Microsoft Office on it.
And they make it the most cheap to back up stuff with OneDrive. Things like that.
They also have like their security platform as well, which obviously is not like the best of breed when you compare it to CrowdStrike. But at the same time, like they could always bundle everything and give employees, or not employees, smaller businesses or enterprises a much cheaper price per seat, which is going to keep their moat just as sticky as it always. It's like, hey, you already have Microsoft Office, you already have GitHub. Let's bundle all of these together and throw in Copilot in there. We'll give you a little bit of discount, and then we can continue with our contract. And it's an easy win for them with a lot of these other companies. Otherwise, you need to bring in another model into the company for AI and then integrate it with all your applications. Microsoft does make it pretty easy to do that. Google does have their Gemini platform, which can integrate, of course, with all the Google Workspace apps. But at the end of the day, you're going to have Microsoft Word, Microsoft Outlook, and everything in your company's enterprise. You might as well just do this add-on, especially if it means a bit more incentive to do it for AI that you do need. And with that being said, I was reading a research report the other day that a lot of companies, I think it's about like 25% of companies, are not hiring a chief AI officer, which means that they're re-strategizing their entire business plan to bring AI into the mix, and they got to bring an executive member in order to help the entire company do that with additional headcount. And when you think about that, it's so hard when you, like you said, companies are willing to pay top dollar for AI products, which is true. But then they're also considering to cut budgets with other services to push more money into that AI infrastructure they're building out, or the AI products they're pulling out. So my job as managing my own portfolio is to find these companies that are going to be ahead of that game and that are going to benefit off of this turnover from going from non-AI CapEx into AI CapEx. But the good thing is that you already have an ETF that does that for people. And considering today, where, I mean, we just had like a 2% drawdown the NASDAQ last Friday, and already we pretty much recovered that plus more today. Last Friday was a good time to buy the dip on Soffel. I mean, it was
dude, there was dip buying. Did you see the shares trade?
I think I was on the spaces this morning. I'd imagine after hours there was an additional large volume of shares being traded.
57,000 shares Friday. I mean, it traded today. Look at AOTG today. Like,
I got to check that one out.
AOTG was at like, I mean, I think that's the dip buying there, but it's like, I mean, that's like what, 40,000 shares or something. I mean, that's a lot. I mean, that's
a lot.
So, I mean, I don't know. It's good that people have have these things on their watch list and they're buying them when they find the right opportunity. So I'm really happy for that. And, I mean, I think the future of this is really bright, especially, Sam, because like AI is lowering software development costs, right? Like, so you just see across the board, people are keeping their expenses constant or they're shrinking them. Like AppLovin and Robinhood reducing their expenses year over year. Both of the stocks are up 300%, or more. I think one of them's up 400%. I can't remember which one.
It's probably Robinhood.
Yeah. But like, look at, they're software companies. Like, I don't care that it's in financial services. What it does is it automates brokerage services, right? So that automation and all of that is done by software. So it's really just a software company that uses their software in financial services. Like, I mean, NASDAQ, like, look at NASDAQ, like their expenses are decreasing year over year, right? And then you're like, well, what does that do to earnings? Like, because really what they're doing is they're automating exchange services. Could you imagine, like, in the old days, the exchanges like writing everything on tickets?
Yeah,
it's all about automating it through software and and what you do is you eliminate huge numbers of man hours. You eliminate mistakes, which are extremely expensive. And so you make it cheaper, you make it faster, you make it better, you disseminate the data better. I mean, in every way you're adding value. They're reducing their expenses. Their income's up over 100% year over year. Like, this is a software company as well. They're coming out with agentic AI agents that fight financial crime for like banks. So like they scan the thing so people don't have to hire people reading through statements like at big banks. I mean, their software business has the potential to become the next big cyber security for like financial services. So, I mean, like, I think the biggest thing is like we have to keep our eye on like who are the next Amazons that start off as this and go into other things, and because there will be some next big players that surprise us in the next 5 years. The cost of software development is falling so much that we could see some really innovative software out of people that have the best talent on their teams, not just the biggest players. And so like, I think you should be long the Mag 7, but I think that like AOTG and SOFL, you don't just wait on market cap, you wait based on other factors like low marginal cost and revenue growth and profitability. And you create this portfolio that is poised for very strong earnings growth, for very strong, to ride the AI wave and to be these companies that provide more value for everybody so we all can do more with less as we continue to automate more complex tasks.
Okay, so tell me about software versus AOTG. I think we've discussed this many times in spaces, but for people who are watching this right now, what are the difference between both of those ETFs, besides the fact that one of them's leveraged?
Yeah, well, yeah, one of them is leverage. So like there's some things you would do in a leveraged fund that you wouldn't do in an unleveraged fund. So basically leveraged funds incur financing costs, okay? They also incur in a sideways trading market, volatility decay, okay? So like if you have a fund, what a leveraged fund, a daily leveraged fund does is it buys on every up day and it sells on every down day. And that way it maintains the constant leverage. Okay. So if you have $100 and then you go get $100 from the bank, you're 2x leveraged, right? And the stock basket of $200 goes up 10%. You make $20, right? So now you have $120 of equity. And you have $100 from the bank. All right. So then you have to go and buy $20 of stock. So to be $120 from the bank and $120 from equity. So you're always buying on the way up, you're selling on the way down. This is a really powerful way to amplify the upside while mitigating risk on the downside. All right. The trade-off there is that if the market trades, let's say it's like at 100 and it goes up to 101 and then it goes down to 99 and it just does that every day for the whole year. You're buying at 101 and you're selling at 99. Right. So you can see that you're buying high, selling low. If you do that for a long enough time, you erode part of the value of the fund. So what you want to do in a leveraged fund is that you can actually take less risk. So you want a lower volatility metric on the portfolio. So you take a little less risk and you put smaller weights on things like Robinhood that trade up and down, like 110 to 90 to 110 to 90. And you put more on companies like Visa that just are a straight one-way chart going up. You know what I mean? But it goes up a lot more slowly. But at the end of the day, in a leveraged fund, like on the back test, you can actually have better performance with a lower performing portfolio, which is crazy. You're like, wait, the index went up less, but the 2x fund went up more. But that's the way the mathematics work on that. So I didn't just 2x AOTG. They're very similar funds, but I actually custom engineered an index to optimize daily leverage and bring that to the market to try to in the software platform sector to try to beat all of so like the existing daily leverage funds like TechL and stuff. Like if you had put like $10,000 in them when they started, like, which is what, like 18 years ago, they'd be worth like $3-4 million today. Like that's how well they've done. These are the best performing funds that have ever been made, right? Like TQQQ, like annualized like rates of these things have like annual SOXL. They have annualized performance since inception of like 30-40 percentage points. You're like, what in the world? I wish I could do that. But here's the thing. They only leverage broad-based indexes. So like these indexes that they leverage are based on market cap. That's it. And you're like you can do the back test. Like it doesn't make sense. You can make a better index with better performance if you include other factors other than just market cap. Like you can weight based on low marginal costs. Like I said, you can weight based on profitability. You can kick out the unprofitable companies in an index because in a bad year, those are the ones that lose 80%, and you don't want to leverage that on the downside. So this is an index that's trying to be a better index and to try to beat some of the best performing funds that have ever been made. Now, AOTG is obviously, since it started, it's already beat the NASDAQ. It's already beat the S&P 500. It's up a lot, and it's beat these funds by a lot, the Dow. And it's beat the tech sector, XLK. It's beat the ARK Innovation ETF, right? So like this is a fund that's already doing very well. And I think that has the potential to be one of the best funds ever made also. And just based on the way it weights on market cap, and not just on market cap, but on all these other factors that are very strongly correlated with having great earnings growth and high share price appreciation. So it's like you can't tell the future for sure. But like, I think both of them are really innovative, good funds, and doing it in a leveraged way. Obviously you amplify the upside, but you compound the shares as you go up. Sam, did you as you buy every day, right? So like in a normal thing, like your shares are always going up in value. In a leverage portfolio, the shares are growing in number is the same time that they're going up in value. So it's like taking something in calculus to the third power instead of the second. So like it's like it would be almost in the long run if you like get the right sector like software platforms that appreciates potentially, like it would be hard for an unleveraged fund to beat that. Like you would need to have the leveraged fund because of the way that share compounding works. It's like very powerful mathematically.
Have you because the ETF just basically just started this year, right?
Like a month ago.
Yeah, a month ago. So what, and in the entire process of bringing the ETF to fruition, like what gave you this idea to do it? I mean, there's obviously probably other daily leverage
Yeah, you're gonna love this.
out
All right.
there. Yeah, go ahead.
So AOTG is up like 100%. I'm like, this is great. But I also own these daily leverage funds like TechL. I'm like, how much are those up? And I'm like, well, not 100%. And I'm like, how did I do better in AOTG than 2x and 3x leveraged funds? And I was like, this is crazy. Why don't I just 2x leverage AOTG and crush them all? Right. Because I actually thought it was a better, like, obviously, if you can beat the index and you can lower volatility, that's going to be really especially better. And like, it's going to amplify that in a leveraged fund. So I was like, okay, I've got to take this to the market. I've got to do this in a leveraged fund, the same strategy or something similar while optimizing, making some minor adjustments for daily leverage. So that was like why, because I'm a daily leverage enthusiast myself. And like all my money is in my own funds, right? Like I really believe in this. And if I thought I could do better in the S&P 500 or like the XLK or whatever, the QLD, ROM, like I wouldn't have opened my funds. Like I would be investing in those. Like this is a heck of a lot of work and costs money to do. So like I'm doing this, for myself. I'm doing this for anybody else that wants to come along on this ride. But I'm doing this because I think it has the potential to be one of the best ever made. So and it would have been had it started 3 years ago. The question is, starting today, the past isn't always the future, but I believe in the strategy that it continues on into the future.
Did you want to do it 3 years ago?
I think I needed to get the unleveraged one out there first. But
okay, yeah. Like, no, I mean the bottom of the bear market.
I was doing this strategy. So my family has like a family fertilizer business, right? And I was investing money for them. I worked at a large family office. I was an institutional market maker after that. So I came from finance. My family has a fertilizer business. I came back when my wife was pregnant and we went to, I worked for the family fertilizer business, but I wanted to stay in, investing. So I did investments for my family in SMAs and I was doing very well. Now, here's the thing, Sam, you can never replicate my performance ever, right? Like you can't do what I do in an ETF because I don't have to pay taxes when I sell stuff. So like if NVIDIA goes up 1,000%, I can trim half the position. To me, like that could be like, like today, you sell half of NVIDIA, like you're talking about 5 million or a couple $1 million. And then you're saving a couple $1 million on taxes, right? So the fund share, like you in your SMA would be getting a couple $1 million tax bill coming due. Now I can take that and I can put that in AMD and I can let that appreciate for another decade or 2 decades, right? So like this is extremely valuable because it's so tax efficient. And so I made this ETF because like I wanted to capture the tax efficiency and there wasn't a strategy out there that I could have bought that I thought would have done better, right? Like I couldn't have bought the Vanguard growth or whatever, like the Charles Schwab growth, like these funds and AOTGs beat them all. Like, so like I was right about that. So I captured the best performance. I was doing this before in SMAs. I rolled it into an ETF. And then I continued to notice that, look, like I improved upon the existing offerings, but I can improve upon the existing daily offerings also. So like a lot of these asset managers you talk to, they don't buy their own funds or they do, it's like hardly nothing. I've got a lot of money in these things. Like I'm doing this because I believe in it and I'm doing it because I think it's the best thing for me. And if that's true, and and if other people like the investment objective, like they can come along for the ride also. And I hope they do because I'd rather make money for as many people as possible. And of course there's always a risk of losing money in any investment. Stocks can go down and you can't tell the future. But I'm a big believer in this and I put my money where my mouth is.
Yeah, it's so hard to be bearish the market right now. I mean, short-term fluctuations, it is what it is, but as an investor, you're going to have to stomach those losses. A lot of people don't really think that investing in the S&P 500 is somewhat risky. And a lot of people do think that it's very risky to do it. But at the end of the day, but at the end of the day, it's regardless of what you invest in, even buying treasuries or even loaning the government money is a risk, but it's the least riskiest thing in the entire world. However, you're not really going to get rich doing that sort of thing. I mean, we're really all in the game to make money. And a lot of it has to do with trading in your time by buying an ETF. So that way you're outsourcing all of that research that gets put into the stocks you're investing in versus putting in that time yourself. I'm sure there's a lot of people out there who could probably outperform a lot of the ETFs that are out there, but that takes a lot of work to do. And it's most likely going to involve a lot of trading. The reason why a lot of people
incurs what a 40%, you take 40% of the profits and give it to the government. So even if you ETFs, I really would be shocked if they were beating them by 40 percentage points, right?
Yeah,
Like
I mean
unfair.
that's a
You know what I
trade-off. The
mean?
short, yeah, that's a trade-off. The short-term capital gains you have to pay for at the end of the day, which a lot of people don't really think about. But if you have
Oh, they
millions of
think about it
dollars, like
after they've
that
done it
matters.
for a couple of years.
Yeah, no, that's true. That's true. I mean, people who like day trade, obviously that's given. But I think that buying and holding has become a more attractive commodity. But a lot of people don't understand. Like you're saying, there's a lot of people who bought Nvidia around $150, and then they want to trim some. They want to put it into AMD, whatever other stock they want to do. And then as soon as they do that, they're creating a tax event. Like you're not really going to avoid that. But a lot of people who do put money in ETFs are doing it for that reason, so that everything is all wrapped up. And that way you don't have to worry about paying these capital gains because you're not the one who's actually doing the selling. It's within the ETF itself, which kind of makes sense a little bit there. But
Which
also
does
for
not
people,
hold true
yeah.
for mutual funds, though. Mutual funds, they pass out the capital gain.
Yeah, what is that? Vanguard? They're the ones with all those popular mutual funds, the boggleheads and
I
everything.
think mutual funds, like, they're pretty popular in a lot of people's portfolios, which is almost horrifying when I see them in taxable accounts. Like it's one thing if it's like your 401k, but like once it's like in a taxable account and they're getting capital gains every year, it's like horrifying.
Yeah, a lot of people, they don't know this stuff, right? They
Yeah.
don't have the education for it, and that's great that we're all here to be able to bring that education out to the average retail investor. Because
Yeah.
there's a lot of things I didn't know before I started doing a lot of these, and there's a lot of things that I learn every single day. And every day, I'm sure I'm learning a lot of things, and every day, I'm sure you're learning a lot of things too as well. The good part is that, it's not a game that just ends in a week. It's not a game that we're measuring performance by the month or anything. It's a game that really is going to last for eternity, right? Like you're investing for your future. People who are investing for tomorrow aren't necessarily investors, they're more traders, but people who want to invest for the long term, live comfortably throughout their lives. Maybe they want to work, which is totally fine, but they want to retire off the good nest egg. I don't think that you're going to be able to retire comfortably today, given just the way that Social Security works nowadays, especially for our age. We're not really going to get a single penny for that. So we have to kind of make our own future by investing in our own funds that do this sort of performance things, plus take advantage of the AI evolution that we're seeing today. And I noticed a lot of your holdings are really centralized around all that. And my portfolio is the same thing. It's really focused a lot on just the AI evolution that's going to be happening in the next few decades. And I don't think it's going to stop for a long time. And I was actually, when you mentioned the fact that AI is going to prevent people from making a lot of mistakes, I saw one of the holdings in your AOTG portfolio for Paycom. And that was I remember when they had that quarter where they dropped like 30-40% because they were cannibalizing their own revenue by releasing Betty. That was basically an AI platform within their own. Okay, if people don't know, Paycom basically makes a lot of money by having an entire accounting infrastructure for all of human resources and accounting. So then that way, when they do payrolls and everything, it's all automated in a single platform and so on. But then they release Betty, which basically prevents people from making mistakes, which is where they made a lot of money from. And this is when Paycom was like $120, $130, and everyone thought it was over Paycom. And now that's a decent weight in your portfolio, and the stock has double that amount, and that fear is pretty much gone. Is there like a decisive period when you decide to allocate funds in your ETFs into these companies when they're on sale, or do you just keep buying as time goes on?
Yeah, so I was buying Paycom. Actually, I would bought the whole sector. Like the payroll software got really destroyed. And so I was buying Paylocity, Dayforce. Well, who else? There was a couple of them. There was a lot, and they were Paychecks. They were all getting destroyed, and like they all had like PE ratios of like 15, 18, and they had like 40% earnings growth. And I was like, enough is enough. So I deployed some capital. They all bounced like a good amount. I think a couple of them went up like 50, 60%. And then they became like, they weren't like super high growth, right? Like Palantir is much higher growth, things like that, like Apple Oven, Toast. So like I did start to trim them down because like I don't wait based on market cap, right? Like if something gets really expensive, like I try to get into the cheaper growth, right? Like right now you've got Toast that has like a price to sales ratio of 4. You've got Figma out there. It's got like a price to sales ratio of like 100, right?
Yeah.
And it has lower growth. So it's like, no, I'm not going to buy Figma. I'm going to buy Toast instead. And so like, I don't like, they're like a lot of tech funds don't like, they just wait based on market cap. Like that, I think like almost all of them, like even the NASDAQ, like, and so like, there's some like really common sense things you could do, I think, to improve performance in the long run. And dude, if you like do the back tests on these things, like it's true, right? So it's like I try to make some common sense adjustments to improve portfolio performance. You're right. Like, and like one of the reasons why I started doing this in the first place, like, 8 years ago, but before AOTG, was just that like people are like, oh, a lot of people for some reason think, like, not everybody, probably not people like you, Sam, but like a lot of people think like you can't beat the index. Like they don't understand the index is just an
I hope
conglomerate
I could beat the
by
index.
market
I'd be
cap.
wasting my time. Yeah.
Yeah. And like you trying to convince the average person that like it's like you can beat the index, like they for some reason think it's like impossible. Like it's like, no, you can't beat the index. And I like it's not true in growth investing, especially. I think there's like a lot of people that skew towards value. And so you've got all these people that are value oriented and they're only buying stuff that's cheap because it's shrinking. And like they kind of skew the performance of like the traditional active managers. Yet there's like this other side of active management that does have a good history of beating the index. And so, I mean, I think it's, I think like it'll be interesting. But like when you think about like the QQQ has beat the Nasdaq quite a bit, right? So like over the past 3 years, like the QQQ's up like over 100 percentage points maybe, and like the Nasdaq and like the S&P 500 or like the VOO is up like 65%. So like the funny thing is, if you go back 5 years, if you go back 10 years, if you go back 20 years, it's all the same. It beats into everything. And so, and then you have a question of like, well, what section of the S&P 500 has done well and what section of the NASDAQ? And you realize the NASDAQ is a higher portion of like software platform companies that make their business by like, I say software platform because it's not just software as a service like the software sector is. It includes companies like Visa and Apple, which act almost like as a digital toll booth where they tax transactions going through like a toll booth. And I think that's like a really powerful form of software as well. And but like you realize that like these things, these companies, this certain sectors is the reason why the S&P 500 has done well. It's the reason why the NASDAQ beat the S&P 500. And then you're like, wait, if I just focused on these in greater detail, like greater focus on the growth of this software platform sector in AOTG and SOFL, I can beat the indexes too, right? Like I can just do it better than they did it. Just like the NASDAQ does it better than the S&P 500. I'll take it. Instead of going and, maybe the S&P 500 does it 50% of the way, the NASDAQ does it 70%. Well, I'm going to take this baby and I'm going to push it to 100% and like see what it does. And it does really well. Like it has historically. I'm optimistic on the future. So yeah, I mean, I'm sure you've come to the same conclusion, and that's how you got into this in the first place.
Yeah, I mean, if I didn't think I could beat the S&P 500, I would be wasting my time right now.
Yeah, right.
I'd be wasting
if I didn't think I could
every
beat
single
NASDAQ.
day. Yeah. If anyone, honestly, most people can't. That's just the reality of it. Most people on their own cannot beat the indexes, and a lot of people fail doing it, and they spend a lot of time. And I think generally a lot of people are very attracted to those short-term gains, short-term trading. So as they try to think that they can beat it one way, they end up doing it some other way and fail miserably. I also think it's really good to, be to kind of diversify your investments. Obviously with the ETF, you are diversified by default. But in terms of like someone's portfolio, if they are doing single stock or single ETF investments, like definitely diversify your investments by not putting all your eggs in one basket. Like for example, not going all in Amazon, right? Because if you did, then you wouldn't necessarily, I think you'd be underperforming the SP 500 year to date if you just did Amazon. But if you had Toast in there, you'd be doing a lot better. Or if you had, Nubank in there, you'd be doing a lot better. I saw you have Nubank as one of your holdings, which is very interesting because that's also another fintech company as well. And if you had Paycom, then you'd be doing extraordinary, right? You'd be outperforming the market just alone. But then you also run the risk that if one of these companies, like if you go all in Nubank, for example, which I had a pretty decent chunk of my portfolio in Nubank for quite some time in the beginning of the year, but no, don't worry. I trimmed when it got back to the 14s because I still think the company trades pretty cheaply. But
it does. The revenue growth is slowing though, like the earnings growth or like in the revenue. That's like the biggest concern to me because like, you see a pretty sharp slowdown, right? Like we were in when it was at like 100% revenue growth.
Yeah, I've been in since.
And now we're seeing it's like coming down to 10, and that gets a little worrisome.
It's a little worrisome too. Also, when their margins when net interest margins are compressing a little bit, that's what like, oh, this keeps going down. That's not good. Hey, but you know what? The delinquency rates are going down too. It's like, yeah, but your net interest margins are going down, even though guys you're expanding aggressively as well. So yeah, I mean that's a thing. I mean, I think we're actually we got a few minutes left over here. Kate, did you want to ask any questions to John?
Yeah, I was going to say, speaking of some of those companies, John, I was going to ask if you could run through some of the other companies that are within these ETFs that people can look forward to done a couple good breakdowns so far, but would love to know about some of the other ones, the other holdings you have.
Yeah, well, I also like the way the conversation was going, because you're talking about like what to avoid when you're starting out, like investing as a retail trader. And you were hitting on, don't put all your eggs in one basket. Because like, all right, so Sam, like what I like to say is that like growth has beaten all the other sectors, value, core, right? Like you look at the 10, 15-year, 20-year chart, the growth does better. Large cap does better than all the other caps, and tech sector beats all the other sectors. So like,
yeah, exactly.
So like what we figured out, right, is if you have a large cap growth technology fund, that's like the holy grail, right? So like it should be pretty hard to mess that up. Now, what you were saying is, how do you mess that up? And you said that you put all your eggs in one basket and guessed wrong. That's absolutely right. You shouldn't be doing that. And the other thing is, like, you should be buying a bunch of them, not just like buying 3 names, right? And then the other thing you should do is you should be buying profitable companies. The other way I saw everybody mess this up in like 2022 is that they bought all these totally unprofitable tech companies, biotechs. They're like, we're going to cure cancer. The next thing you know, they're all bankrupt. So it's like, I think like and like a lot of those like also tend to be small cap. And I think that like there's a lot of economies of scale in this. Like there's buybacks instead of outrageous stock-based compensation. So like you want to like definitely gear that way, like as like to avoid pitfalls. But like I said, doing it in ETF, I think it's better to find a strategy. I think it's better for people to do it in the ETF, right? I think it's like with the majority of their money, like as a long-term holding and not day trading it. Like, I think if they want to have fun day trading, that's great, but don't do it with like the majority, like with a lot of your savings. Like have some fun stuff aside and keep learning about the markets, but mainly have like a long-term buy and hold, whether you do that with like the S&P 500, like VOO or QQQ, or you do it with a fund like AOTG, because you think that one has the potential to outperform by quite a bit. I think that that's like a smart thing. Like long-term buying and holding is the biggest advantage a retail investor has. Like not trading. Like it's like finding a strategy that they're not going to turn over a bunch. And like, I think that when you look at funds that you want to buy, you should decide that you want something that's like repeatable, right? So like some people might be like, hey, momentum's done really well. Do I think this is repeatable? The worst thing that happens is that it loses 30% and you think, oh, I hate that I'm in this momentum strategy. I don't even understand it. I want out, right? And then you sell. So like you really want to be in something you believe in, the long-term repeatability.
Exactly. Yeah.
And the problem with a lot of active funds is their strategy is I buy high, sell low, and they have high turnover and like it's not repeatable. And like the best thing you could do, like AOTG and SOFL, are really like the portfolios itself are geared towards like long-term buying and holding for long-term capital appreciation with low turnover. So I think that's like a pretty interesting thing for retail people to keep an eye on. Going back to some like single names, right? Like I think that the credit card companies are all really interesting. And I think just because like the growth comes at very high profit margins and they're continuing to show strong growth. And I also think that like, as we go into like other ones, like AppLovin's
sorry, John. It cut off for like 10 seconds. You were talking about how the credit card companies are starting to become very interesting, and then it cut off for a little bit.
Well, I think for people, they have to understand like there's a portion of your portfolio that's really geared towards high growth, right? And like that's like my Toast and my Nubank and things like that, like even Microsoft. And then there's a portion of the portfolio that you want to be pretty steady, because like you don't want to risk having like an 80% drawdown or something like. So I think the credit card companies have the ability to continue growing their earnings at 20% year over year. I think that like the stocks have that potential to appreciate at 20%, which is like a pretty, like if you're doing that year over year, like I think AOTG right now is a lot higher than 20% annualized since inception. But if you can do 20% annualized since inception, that's like a pretty good like investment performance. Like it's like ranking you in
beating
like
Warren Buffett
of all time. So like I think the credit card companies are fairly safe and have the potential to help like be a good safe pad of like when the recession hits, people are still using their credit cards and things like that. And there's still that transfer in a lot of parts of the world from cash to digital that's still taking place. So I think that's like a good, interesting one. And we hit on the payroll ones. I mean, What else is interesting to talk about, man?
I mean, if we really want to talk about some stocks in our portfolio, we could talk forever because we already brought up Nubank. It's such a controversial stock for like the last couple of years. Actually, no, last year. Yeah, ever since their growth rate's been slowing down, I've really been keeping an eye on that. And I still have position Nubank, but I've rotated part of those proceeds.
Did you
into other
own
companies that are
D-Local?
cheaper. I did own D-Local for a little
I
bit.
knew it, man. You're all in the Latin America one.
Oh man, I love fintech. It's so interesting. I actually wrote an article about it. But what I found really interesting with Nubank is that yes, they're growing very quickly and their growth rate, but it's just slowed down dramatically. I thought that had a lot to do with the dollar appreciating at the beginning of the year, which is the reason why they probably got hit so hard. And then I expected the last quarter to be really good because the dollar's appreciated so much. So when you take that currency conversion, it'll actually make their earnings look a lot better, make their revenue look a lot better. But that exactly was not the case. The stock kind of topped out around $15, then has pulled back since then.
Yeah.
How about Mercado Libre? Do you still own that?
I own Melly. Yeah, it's a top holding,
Goodness.
like in my AOTG. I'm trying to look at the weight in it right now, but I think it's around like 2.6%. So it's not a top 10, but it's definitely a top 20. And like you're right, the numbers are there. I mean, I think one of the biggest things, because like Sam, I've got to like get you outside of tech and just like let's be common sense. Like, what is tech? And like I think some of the brokerage services as AI like reduces like operating expenses. And
I have a big holding in Robinhood.
Yeah. Robinhood,
one of the biggest holdings,
dude. Yeah. Charles Schwab, LPL, like look at their earnings growth. Like,
no, that was pretty big one. Interactive Brokers was one that I did trade. I should have held on to it, but I did Interactive Brokers and Fiserv. Considering they also own Clover as well. That was a really interesting one too as well. I didn't see Fiserv in there, but I do see that Robinhood is one of your biggest holdings. So you must have really benefited off of that one if you guys bought the dip last April, because that thing was at $30. And it was like, this is a great opportunity to buy Robinhood right now. This is insane how it's pulling back so far.
Yeah. I mean, so that one was like something I haven't been in that one since inception. So yeah, that was one of the ones that it just got so cheap, and like it was cheap and the growth was great.
Yeah.
You're looking at like this like 50% revenue growth. And it's got like a super low PE ratio and like a tiny price to sales. And then you look at the competitors like Interactive Brokers,
exactly.
And Coinbase, and they're trading at 10x the valuation metrics. And you're like, and they're not as profitable. And you're like, this is crazy. Like, this is just crazy that this. So yeah, I loaded up. I was buying a ton of it, millions of dollars worth. And like,
that's very cool.
And like it went up, and I think it's up, hundreds of percentage points. And I don't know, because I was averaging it. I can't remember my exact average, but yeah, I think I was buying well before the 30s, man. And so it's been a really good one.
Yeah, there was a point when it was trading less than the amount of cash they have in their balance sheet. This was back in 2023. And it was less than $10.
Got a black eye because of the GME thing, right? The GameStop.
Yeah, no, it was not a good taste in people's mouth because they looked at Vlad as a very bad man and stuff.
I was watching, like, so my neighbor uses Robinhood, right? And like, I'm not gonna lie, I went to sign up for it, and they like sold my cell phone number like the moment I signed up, and I get like all these text messages. Hey, you're looking for remote jobs? And I was like, these bastards are
short the stock.
And then I go to link my bank account, and they're like, we're going to take all of your credit card transactions, and we're going to sell it. And I was like, what in the world? I couldn't opt out. It wouldn't let me opt out.
Yeah.
So I was like, I kind of turned off, but then like I kept doing my research on it. And like, I'm watching podcasts, and it's like the All In podcast, right? And everybody's like holding up their Robinhood Gold card. And like, I love Robinhood, and they're not being paid to do that. And like these are billionaires using Robinhood. So like my neighbors are using it. These billionaires are using it. I'm like, they've got to be providing a lot of value for people. Like that's like, and like there's more to this story. And like they're an innovative company, and like they don't get knocked out. They pick themselves back up, and they keep going, and they don't give up, and they don't surrender. And like we know people that do stuff like that, whether it's like Elon Musk or things like that. Like that's what you want in leadership. And then like So like there's like a lot of like, and then like they come out that they're going to be doing tokenization of like stocks,
Exactly.
break down borders across. And so like this is just like great. The upside in this, I think, is like difficult to underestimate. And they're continuing to automate their US services so that they continue to increase like the profit margins on like the business. So like everything about it is good. You've got this huge tail risk at the same time the US business is like doing very well. So I don't think there's much risk there either.
Yeah, no, that was actually you were talking about the product launch that they had for the tokenization product launch. I think that was the name of it. But they have had multiple product launches. And whenever I think of great CEOs, I don't think of them as just people who know how to run businesses, right? I think of them as great visionaries, but also great product managers as well. I mean, if you look at Vlad's background, it is all product centric. He even has like a math-based company that he's running a venture on the side as well, where he's trying to push that one out. He is like your real life geek, but he's running a multi-billion-dollar company, which I think is back over $100 billion today. And like you're saying, the fact that generally people who run phenomenal companies that continue to grow, they don't just stop and keep doing whatever they're doing. They continue expanding and innovating and kind of changing the world as well as how business is done in their particular sector. And that's exactly what Vlad is doing. He's taking a concept, a traditional legacy concept of just taking people's money. You can buy stock A, you can buy stock B. He made it a really cool product in terms of an application interface. And then he's scaling out, not just in the US, he's offering the services to Europe and places around the entire world. Where if you think about that, you have this holding your portfolio too. And I also have it as well. I have Axon Enterprises. Mm-hmm. They're doing the same thing by expanding into Europe. And I feel like not only that, but also with the smartphone penetration of being able to release technology to not just the US, not just the Western countries, also people around the entire world who are getting cell phones for the first time. And then on top of that, you have internet connectivity being available for people around the entire world. These companies that are based on that entire concept and vertical it's like you said, it's very hard to forecast the upside in it because the industry isn't growing linearly, it's growing exponentially. So if you have all those factors baked into this, to me, I believe as the market continues to make new all-time highs and continues to go up, it's going to lift all of the boats up with it. But then these leading companies are the ones that are really going to outperform the market 2 to 3 times more in the next 10 years than the index itself. I mean, think about it this way. A lot of people, and there's a lot of disbelief in it too, right? A lot of these companies that do well, there's always massive controversies behind them. I mean, let's think about Apple 11. You have Apple 11 in your portfolio, okay? When Adam, oh man, I keep on forgetting his last name, but when
do we remember when that thing was like $17? Like it's like
I didn't get it when it was $17. I bought the dip on it. I bought the majority of it after Muddy Waters came out with their earnings. Came out with the short report, and the stock got slammed. That's when I was buying hard. I missed it when it was like $17.50, and it was of course another one of those companies where it's like, oh, it's already over $100, already in 5 times more. I already missed it, right? Which is the worst mistake I've ever made.
And they were making so much money, and they were announcing just enormous buybacks.
Yeah,
wait. Yeah. So they're buying back all the stock. They're growing like never before. Sometimes the market gets the narratives wrong, and they do. I mean. They got the narrative wrong on Apple 11. Do you want to know what was the thing that was really good to beat up on it with? It was like mobile video games, right? Like, so like they started as like mobile video games. So like, I think that was like, just like Robin Hood got a black eye from GME. People are like, oh, Candy Crush, stuff like that.
Oh yeah. Yeah. Like, I mean, they sold that business off anyway.
Yeah. All these intelligent people that do stocks are like, they couldn't even imagine wasting their time doing something like that. And they're like, there's no future in this company. But what they did is they took their video game business. They were like, wait, we don't want to pay people to run ads on our own video games. Let's just build our own ad platform. There you go. And they made it so anyone that has a mobile app can monetize their ads and cut out the middlemen, right? Like, and so cut out like a lot of like the Googles and stuff and put ads on their site. So it provides enormous value. And I think at the same time, people expected there to be a move, after COVID back to like the office, like back to the PC. And then yet we just kept going further into the it's like I work on a PC, but like we kept going further into the mobile instead. And so so like now, like we know like the gaming sector, right? Like we've seen like AMD's gaming sector get annihilated. Like everything's going to mobile, which is like kind of crazy. But like, especially like for our generation to think back, like you can't imagine playing a game on our phone, right? Like,
Can't
So
imagine
like,
it. Yeah.
but like the young generation is like playing their games on their phone. They're not like doing it on the desktop PC anymore. So it's
Yeah,
like,
no one does that anymore.
but
No one
like
plays World of Warcraft anymore.
the wins are blowing the way
Yeah.
AppLovin is, and they actually became just like an ad platform, like a software platform to help bring in ads and lower costs of advertising and fees like in that service. So I think like that's another one that the narrative just got totally lost. And anyone who recognized that like has done very well, because it's up like over 1,000%, I think, since then.
And it's heading back to all-time highs again. It just needs to get added to that SP 500 on Thursday, and then we'll see new all-time highs on it. Like that story, that cat and mouse story with all these companies is so ridiculous.
Is it really
So
getting added to the
yeah.
S&P 500?
Yes, no. So Thursday, I believe Paramount, they got acquired by another company, and that acquisition is supposed to close out on Thursday. So that's going to leave another opportunity for Robinhood or AppLovin to get in there again. That's what I was reading.
I was surprised with Square.
Yeah,
and I was surprised.
No one saw that coming.
Dude, I remember sitting there like 4 years ago, people being like, the trade desk is the next one in, like, and it took them that long. And then Square got talked about all the time. Square's the next one, especially like 3 years ago when they had this big crypto business that I don't even know what happened to that. And,
I don't know what happened here. Yeah.
and like then they get like they got in. Euphoria leaves, the stocks go down, like, and like they kind of,
it wasn't even on my list.
And then they add them.
Yeah.
I'm like, why are they missing companies like Toast, or like why did they miss Tesla for so long? And I don't know. I mean, there is like an active management part to the S&P 500 that I kind of think they skew towards value, which I think is historically, and it's a mistake. Yeah. I bet those people on that committee get paid a lot. And Sam, you and we should join it.
I would love to be part of that top 1%. I would love to do that. And then I'll create my own ETFs and everything. It'll be awesome. Yeah, but I think we're running out of a little bit of time here. John has been great. I think one of the great things about this, about the show, is that you know your stuff when it comes to software and the holdings that you buy. A lot of people, they buy based on certain metrics, running valuations. Like, the story, the fundamentals, the metrics, and that's very important when you think of a fund manager as well. So really appreciate your time again, John. Hope we can do this again. Cade, you want to close us off?
Yeah, sure. Yeah, Sam, by the way, Sam, this is a super fun conversation. I learned a ton, especially since I spend most of my time over on the Bitcoin side of things. I was actually going to ask John, maybe this will be like a final comment here before we wrap, just because something I was thinking there towards the end. But, John, we went through a ton of stuff, went through a lot of the various stocks you guys are going through, and really, really good deep dive actually in a few of these. I was curious you mentioned a couple of specific stats that you zoom in on to decide whether or not you're going to jump into the stock. And I was curious if there's any other specific things that you zoom in on that maybe separates you from other investors that comes to mind before we jump.
Nobody else, to my knowledge, uses low marginal cost, which I think is really interesting. And like when you think about that, what is low marginal cost, right? Like it's like the cost, you want the cost to be as close to zero to invest in the companies. That means that incremental sales come at very high profit margins, right? There is tech that's not low marginal cost, right? So like think of like Uber, right? Like the cost for them to provide one additional ride is actually quite high. Same with Instacart, right? Like where like the profit margins actually like on the total sale is very, very small. So like you would rather be towards that like Microsoft Copilot or like the Toast, right? When you're investing. And I like when I went back and I did like the backwardated tests, the biggest factor I saw with high share price appreciation was actually low marginal cost in their products. So like I'm kind of surprised nobody else has done it, but that's what I focus on. That's what makes SOFL and AOTG so unique. And I think that investors should keep an eye on that in their own portfolios, or if they think it's like a good strategy to put in their portfolio, because they have the long-term belief that that's like one of the reasons why the NASDAQ's done better than the S&P 500 historically. And if they want to take that and take it, and push it a little further. So I mean, it's been a pleasure, Sam. It's been a pleasure, Cade, to see you again. Yeah. Thank you, guys.
Yeah, John, thanks so much for coming on. And for anyone who's watching, if you haven't already, please definitely give John a follow. And also give Sam a follow if you haven't already. And if you're on YouTube, by the way, you can do all that down below in the description. If you're on X, just right above our faces if you enjoy the conversation. Also, please do repost the stream if you enjoyed it. It is a recorded stream, so people can go back and listen if they missed the stream. So it is the best way to support. And guys, we'll catch you guys all in the next one. And we really appreciate all of you. See you guys next time. Take care.
All right, take care.